The main things is that it's not a publicly registered vehicle, and it allows one to structure the portfolio.
Fed researchers have warned in recent weeks that a resurgence of a popular hedge fund trading strategy that exacerbated the world's biggest bond market crash in 2020 could cause disruption to US Treasuries. So, how have hedge funds led the whole Treasury market vulnerable to falling apart? Let's analyze. The Bank of England stepped up warnings about hedge funds shorting US Treasury futures, saying its measure of net position is now longer than before the dash for cash crisis in March of 2020. The net short position has grown to $800 billion from about $650 billion in July, the central bank said, citing calculations based on Commodity Futures Trading Commission data. That suggests a jump in the so-called basis trade, which is where investors seek to exploit price differences between futures and bonds. Hedge fund short positions in some Treasury futures, contracts to buy and sell bonds for future delivery, have recently been exposed in so-called basis trading, where the Treasury takes advantage of the futures contract premium over the price the underlying bond reaches. It has reached an all-time high. Trading, typically the domain of macro hedge funds employing relative value strategies, consists of selling a futures contract, buying a government bond for delivery into that contract using repo financing, and taking delivery at the expiration of the contract. The sudden movement in the US Treasury market, sparked by Silicon Valley Bank failure, has upended one of the most popular hedge fund trades in recent years. The bank's failure raised concerns that the Federal Reserve may have to avoid aggressive interest rate hikes to avoid putting pressure on the nation's entire financial sector. This has led some investors to look for safe havens. Both factors caused bond prices to soar. Analysts and investors said that the policy quickly clashed with the broader market consensus that interest rates would continue to rise and bond prices would fall to fight inflation, costing many hedge funds huge profits last year. Now, some of the most successful macroeconomic and computer-driven hedge funds in 2022 have been busted, causing some funds to rush out of positions and adding movement into the bond market. The large reversal in treasuries show that the once contrarian inflation trade is becoming crowded, said Andrew Beer, managing member at US investment firm Dynamic Beta. He added that changes are being made quickly. Market watchers said that this likely contributed to a recent big jump in bond prices, which may have pushed the yield on the 2-year US Treasuries to $4,440, the highest level since 1987, it said. Fed economists have warned in 2 separate memos in recent weeks of the potential financial vulnerability risk associated with such transactions, which could lead to higher interest rates and uncertainty about future monetary policy actions. This comes at a time of instability in the US Treasury market. Fed economists said in an August 30th note that spot futures basis positions may face new stresses during a broader market correction. Given these risks, trading requires continued and careful monitoring. Separately, in a September 8th memo covering hedge funds' Treasury exposures, the Fed said, economists said that there was a risk that repo funding costs would rise as repo funding costs rise. Quick liquidation of basic trading positions could exacerbate episodes of market stress. It could lead to increased volatility in the US Treasury market and increased disruption in the US Treasury, futures, and repo markets, they warned. Short positioning in some US Treasury futures has reached record highs in recent weeks, and long positions at major asset managers also signal basis trading. The Fed is unlikely to view this underlying asset accumulation too favorably and may try to act on it at some point, says Steven Zinn, US rate strategist at Deutsche Bank. But the Fed doesn't directly supervise hedge funds, so the approach they take may not be easy, he said. The Fed declined to comment on possible policy actions. In March 2020, as markets slumped due to growing concerns about the coronavirus pandemic, the unwinding of underlying trades contributed to a liquidity shortage in the US. Treasuries, prompting the Federal Reserve to issue a US $6 trillion added purchase of US bonds. Some market participants are concerned that a similar situation could occur again. Barclays said, the underlying physical futures contract are vulnerable to 2 risks: higher margin costs for short futures position and higher funding costs for long cash positions. If funding costs rise in the repurchase market, where hedge funds take short-term loans against US Treasuries and other securities, futures on underlying cash in the US, Treasuries may need to maintain the profitability of underlying trading positions. The spread or premium on the contract will also need to rise. Conversely, a sudden economic downturn and a rapid decline in interest rates could cause future prices to rise, impose maximum loss limits, and force the termination of basic trad US. Deutsche Bank Sinn said, this could lead to a repeat of the market turmoil of March, and Fed is keen to prevent it. In early August, the US Treasury found itself at the center of increased market volatility. Better than expected, US economic growth has given investors more confidence that interest rates will continue to rise, fueling the rise in yields. Additionally, several announcements made around the same time increased investor uncertainty and led to selling. These include an unexpected increase in the issuance of long-term government bonds by the US government, increased flexibility in the Bank of Japan's yield curve control policy, and downgrades of government bonds. The upward pressure on US yields has spread to other UAE government bond markets. According to the ISB Move Index, a measure of investor premiums, volatility in the US Treasury market has exceeded even the tense conditions at the beginning of the coronavirus pandemic in March of 2020. It reached its highest level since the 2009 financial crisis. Defaulters are willing to pay to protect themselves from market fluctuations. The extremeness of this move seems to have led to some forced buying, said Gregory Whiteley, portfolio manager at Double Line Capital. It's been a brutal day, said a hedge fund manager whose fund lost money. Market participants say recent market turmoil has forced many hedge funds to exit loss-making trades. Among the companies affected was the Rotterdam-based Transtrend, which managed $5.6 billion in assets, 9.6% at Man Group, one of the world's largest hedge funds, and its HLO divers. The Citified Fund lost 4.2%, and the HLO Alpha Fund lost 2.2%. There was also a significant recent recovery. When the bonds also rallied strongly, bets on rising yields generated huge profits for managers like billionaire trader Chris Rockos last year, with Rockos Capital posting a 45.5% rise. Its 2-year bond yield rose from 0.73% to 4.4%, supported by bond bets with Hydal's Capital returning nearly 200%. According to the Commodity Futures Trading Commission, in the first few weeks of 2023, many speculators believed the price of 2-year Treasury bonds, which are sensitive to change in interest rates, would continue to fall. The size of these positions reached a US high in mid-February according to regulator statistics. The fund bet is more than twice as much on a 2-year US. Treasuries are failing, but more than tripled on the 10-year Treasuries. A US data company, Aon, in January caused data delays, but sharp movements in the tariff market suggest that SVB held positions before its collapse. Many computer-controlled funds that try to navigate financial market trends have long bet on the US Treasuries and other government bonds as prices have fallen. According to Societe Generale's Trend Indicator, which models bets by these quantitative funds, they have been placing negative bets on 2-year US Treasuries for nearly 2 years, and have also shortened other major global government bonds. While some managers were surprised by the sharp decline in bank stocks, hedge fund problems are primarily focused on bonds, whose prices are closely tied to the change in interest rates. Despite the decline in bond yields, stock indexes have remained relatively stable, suggesting to some investors that the move is not primarily due to fundamental macroeconomic factors. Points out, people are not expressing their opinion, said Christian Kopp, head of fixed income at Union Investment in Frankfurt. It was a focused repositioning, he said. As bond prices rose, bets against them going down disappeared, forcing hedge funds to close out the bonds, which in turn pushed up prices and forced them to unwind more negative positions. This is a typical feature of a large but fast-moving market. Treasury yields have rebounded, but only offset a small portion of the dramatic decline in recent days. The magnitude of the recent move suggests that the initial decline may have been exaggerated by speculative market positions. So that's all for today. What do you think about the Treasury market vulnerability? Does the US tackle liquidity? Comment down on your thoughts below. And don't forget to smash the like button and subscribe. Until we meet again, we'll be seeing you.